the heart of a seed, buried deep, so deep, a dear little plant, lay fast asleep. Awake, said the sunshine and keep the light. Awake, the voice of the raindrops bright. The little plant heard and rose up to see what's the wonderful outside world might be. Assalamu alaikum. Very good day to you all and dear learners and who are now in front of myself, and here I am Muhammad Mahbub Hussain. Presently I am working as a lecturer of accounting. My working station is now Government Saudi College Magra, and today I gonna take a session on financial management, and here the respective topic is about the acceptability of an investment project using the net present value method. About the acceptability of an investment project using the net present value method. I am expecting that this presentation topic will be very easy, simple and understandable to you. And at the end of this lecture, you will understand all the points very clearly and sharply. So let's go to the slide. What's particular item we will learn from here? Number one, plant expansion, equipment selection, equipment replacement, lease or buy, cost reduction. These particular 5 items we have to consider while capital budgeting decisions for accepting or rejection of the project. Capital budgeting tends to fall into 2 broad categories. Number 1, screening decision. Here, the question is set up in such like that: does a proposed project meet some preset standard of acceptance or not? And number 2, preference decision. That means selecting from among several competing courses of action. That means there are several courses of action will exist in front of you. You have to choose the best one. And in case of screening decision, you have to set a question in such a way that whether this proposed project can able to meet the standard level of acceptance or not. So the question, time value of money. You know very well, $1 today's worth is more than the dollar from now. So therefore the project that promises earlier returns are preferable to those that promises later returns. In a nutshell, we may say that today's 1 taka is not same as previous as future. That means now 1 taka's value is equal to taka 1. Previous 1 taka and tomorrow's 1 taka certainly is not same as like as now. So time value of money. In this case, we have to consider the best recognized time value of money are those involve discounted cash flows. That means discounted cash flow is the best measurement for time value of money. So today's learning objective is evaluate the acceptability of an investment project using NPV method. That means net present value method. For calculating net present value method, we have to consider 3 points. Number 1, you have to calculate the present value of cash inflows. And number 2, you have to calculate present value of cash outflows. Then you have to subtract the present value of the outflows from the present value of the cash inflows. The question may come to you, which one will be accepted or which one will be rejected, and whether it will be accepted or rejected. When the question comes to you for determination of net present value method, then if the figure or the result may give positive, you will accept it. You will accept the project. In case of negative, you will reject the project. Whether it is 0, then you may accept it or reject it. But you are suggested that in the examination, you will accept it when the NPV will be 0. Okay, in a short, we may say as like, when NPV will be greater than 0, it will be accepted. When NPV will be less than 0, then it will be rejected. When NPV equal to 0, you may accept it or reject it, but you are suggested that you will accept it. Okay. Net present value methods in this way. Net present value analysis emphasizes cash flow and not accounting net income. Actually, the reason is that accounting net income is based on accrual that ignores the time value of cash flows into the out of an organization. As it is accrual basis, as it is not cash basis, this is why, though also some cash are involved here, but it is based on accrual basis. This is why we have to ignore it. We have to avoid it. Now, it is time to know the items which are included as outflows. Outflows means the amount which will set aside from the capital. That means which you have to set aside from the project as expenses. Number 1, initial investment. Initial investment we will indicate by using bracket or negative, as it is cash outflows. Outflows we will symbolize by bracket. First bracket. Number 2, incremental operating costs. That you have to give the project one by one. Number 3, working capital. And number 4, repair and maintenance. So initial investment, incremental operating costs, working capital, repair and maintenance expenses. These particular items are considered as cash outflows. So which one or which are usually considered as cash inflows? Salvage value. Salvage value means the last amount of an asset that could be sold instead of the same factors. Salvage value, this amount will come to your project. This is why it is also called cash inflows. Reduction of cost. Some particular items of cost has been set up for using, but you have minimized the cost, and this is why reduction of cost will raise. It will be considered as cash inflows. Incremental revenues. As incremental expenses are considered outflows, so incremental revenues will be cash inflows. Release of working capital. That means this capital would not use for the implementation of the project. This is why it will be considered as saved money, and it will be known as cash inflows. Okay, and these are symbolized by positive figure. It is mentionable that depreciation is not deducted in computing the present value of a project because it is not a current cash outflows. And discounted cash flow methods automatically provided for a return of the original investment. Now, a problem to your examination will be given by the examiner and you have to solve it. So let's describe and understand the problem and solve the problem. Carver Hospital is considering the purchase of an attachment for its X-ray machine. And for this reason of being, the particular items has been given to you cost $3,170. Its total life is here 4 years. 4 years. salvage value nil, that means 0, and increase in annual cash inflows. Cash inflows means revenue 1000, that means same by maintaining the 4 year 1000, 1000, 1000 and 1000. In 4 year $4000 we will consider as cash inflows. Additional information for you: no investment are to be made unless they have an annual return of at least 10%. That means from this project at least we are expecting 10% return. If this project can't give you 10% at least, then you will reject it. If it can able to give you 10% return, then you will accept it. Okay, will we be allowed to invest in this attachment? That means whether you will accept it or reject it, this project. So we have to calculate present value at 10% factor. So it is time to know the present value factors at 10%. As the question asks to you, 1 divided 1 plus 0.1 to the power 1. That means 10% means 10 divided 100 equal to 0.10. So we will get 0.909 for the first year. For second year, 1 divided 1.10 to the power 2, then we will get 0.827. In third year, 1 divided 1.1 to the power 3, then we will get 0.751. And fourth year, we will get 0.683. In what way? 1 divided 1.1 to the power 4. So at the end of the fourth year, cumulative present value factors at 10% will be 3.170. 3.170. Okay. Now you have to solve. We have already known the factor and present value factor at 10%, and now the time to know the recovery of the original investment. That means our original investment was $3,170, and as it is outflows, we will symbolize by bracket. So item, year, amount of cash flow, 10% factor, present value of cash flows. Now means 1. Now means 1. Because today's 1 taka is 1 taka. But today's 1 taka is not same as future. Today's 1 taka is not same as previous. But today's 1 taka is same today. This is why it will be symbolized by 1. Okay, 1. So now means 1. How much initial investment or cash in outflows? $3,170. So if you multiply this amount by 1, the cash outflows will be $3,170 present value. So present value is the same, will be the same for now. But at the end of the fourth year, 1,000, 1,000, 1,000, 1,000, that means 4,000. So if we multiply by every items, we may get it. Similarly, we may multiply by 3.170. 3.170. Look, how much amount? 3.170 in fourth year. This is why 170. So if we multiply by 1000 into 3.170, then the figure will be $3.170. So minus figure plus figure equal to the net present value will be 0. That means at the end of the fourth year, the initial investment will be recovered. Am I right? Here the 10%, 12% and 14% present value factors are given to you. So look, At the end of the fourth year, the initial investment will be recovered. So it is time to explain in a nutshell by formatting system. Recovery of the original investment. 1, 2, 3, 4, 5. 5 points. Year 1 to 4 year. Investment outstanding, and now means whole amount is outstanding. That means due 3,170 is the initial investment. Or now cash inflows, how much amount for the first year? 1,000. Second year 1,000. Third year 1,000. Okay. Return 10%. 10% return you have to impose on it. How much amount? 10% on 3,170. Then the interest will be 3,170. So what will be the recovery? Recovery will be 1,000 minus 317 equal to $683 is the recovery amount. So what will be the unrecovered amount for the first year? This amount, that means from 3,170 minus 683. Then you unrecovered amount will be 2,487. Similarly, at the end of the fourth year, this amount will be it is the last amount of the first year, but it will be the first amount of the second year. It is the last amount of the second year. It will be the first amount of the balancing amount of the third year. It will be the ending balance of the third year. It will be the beginning balance of the fourth year. So at the end of the fourth year, the recovery amount, if you sum up from here, the recovery amount 3,170. That means this is the total recovered investment. Total recovered investment you will get at the end of fourth year. So by taking 10% present value factors, we will get this investment as a recovered amount at the end of the fourth year. So certainly it may be accepted. If it is for the 5 years, in the fourth year we will get our recovery amount. So two simplifying assumptions are usually made in net present value analysis. Am I right? All its flows other than the initial investment occurs at the end of the period. All cash flows generated by the investment project are immediately invested at a rate of the return equal to the discount rate. So, choosing a discount rate. The firm's cost of capital is usually regarded as the minimum required rate of return. And second one, the cost of capital is the average rate of return company must pay to its long-term creditors and stockholders for the use of their funds. Second problem to you, usually for 10 marks. These types of math will be given to the question paper. Lesser company has been offered a 5 years contract to provide component parts of a large manufacturer. The information are as follows. Cost of special equipment $160,000. Working capital required $1 lakh. Line equipment for 3 years 30,000. Salvage value of an equipment in 5 years 5,000. Annual cash revenues and costs are given. Sales revenue from the parts 750,000. Cost of parts sold 400,000. Salaries, shipping, etc. are given 270,000. These particular items, usually 7 particular items are given to you. And for additional information, at the end of the 5 years, the following capital will be released. Where? At the end of the 5 years, the capital will be released and may be used elsewhere by ledger. Leather company uses a discount rate of 10%. So should the contract be accepted or rejected? The question to you. Okay. It is time to solve. Now we have to know the cash inflow from the operation. Sales revenue, how much amount given there? 750,000. It will be the plus figure as it is cash inflows. Cost of parts sold. Cost of parts sold. How much amount? 400,000. That means 4 lakh. Salary of shipping. How much amount? 270. 270. So by sum up, we will get net cash inflows 80,000. Salary is revenue. It is the income. Okay. Salary is revenue. Cost of parts. That means our cash outflows. This is why we symbolize by the negative symbol by bracket. Salaries, it is also cash outflows. This is why I symbolize. So cash inflows, how much amount? 80,000. Okay, we have already understand which one will be cash inflows, which one will be cash outflows. Cash inflows is positive figure and cash outflows will symbolize by negative figure. That means by using bracket. Okay, so it is very clear. 80,000 is the cash inflows. So investment in equipment now means, we have already said, now means 1. Now means 1. How much amount? 160,000. $160,000. That means $1,60,000. Working capital now means 1. Similarly, 1 lakh. Okay. Even after that, annual net cash inflows for at the end of the 5 years. How much amount? We have already calculated 80,000. And 80,000, the cumulative present value at the end of the 5 years will be 3.791. We will show you in front of you so that you may understand very clearly. So if you multiply 3.791 within 80, then you will get that $303,280. So relying equipment at the end of the 3 years, 30,000 cash outflows. 30,000 cash outflows. So you have to multiply with the present value factors at 3%. 3 years at the end of the 10%. 3 years at 10% factor. So the amount will be $22,530. Okay. I have already said that I will show in front of you the figure present value. That means look, present value factors are 10% at the end of the 5 years. 5 years, how much amount? 3.791. 3.791. Okay. So initial investment. So salvage value at the end of 5 years, as the question has said to you, at the end of the 5 years, $5,000, and the present value 1 factors of 5 years at 10% will be 0.621, and it will be 3,105. So working capital release at the end of the 5 years, 1 lakh, and factors point is here. So the positive figure will be, that means it is the cash inflows, cash inflows, cash outflows, cash inflows, cash outflows, cash outflows. That means here 3 cash outflows and 3 cash inflows. So by sum up, we will get 85,955 is the present value. Am I right? So as it is the positive figure, certainly this contract accept the contract because the project has a positive net present value. I hope you understand very clearly. So it is time to quick test. Deny associate has been offered for 4 years contract to supply the computing requirements for a social local bank. And here the particular items are given to you. Cash flow, equipment, how much amount? 250,000. Computer equipment, working capital required 20,000. For upgrading the equipment in 2 years, the cost is 90,000. Salvage value is for 4 years 10,000. Annual net cash inflows 120. As here said that annual cash inflows how much amount? 120,000. Okay. Besides, you have already said that you have already observed here. It is also cash inflows. It is cash outflows. It is also cash outflows. It is also cash outflows. Upgrading, it is an expenses. It is also set aside from the capital, so outflows. It is also it will come to your business, so it is cash inflows. And it is also said here that cash inflows is how much amount? $120,000. Okay, working capital would be released at the end of the contract. As said, deny assets requires at 12% return. So uh, what is the net present value of the contract within the local bank? It is the question to you. Okay, let's go to check. Let's go to for check. At 4% factor, present value 4% factor, we have to observe here so that we may understand very clearly what we have to do. In the parts, we have to take the decisions very clearly. Okay, at the end of 5 years, the total cumulative cash and cumulative present value factors at 10% will be 2.914. So quick test. The answer will be $28,230. So in what we have to calculate? Now means 1. Now means 1, 250. Okay, 250. Now means 1, 20. Okay, 20. So it is net cash inflows. Has already said 2-year question paper. At the end of the 4th year, 2.914. So we have already said here. So 3.349,680. So upgrading at the end of the 2 years, 90,000. So here 69,200, 170. It is outflows, cash outflows. It is cash inflows. And in this case, salvage value cash inflows, as it is positive figure. As it is said that at the end of the 4th year, the working capital will be released. Working capital will be released 11,840. So total net present value is 28,000. Am I right? 28,000. For your better understanding, just I have to go back. Look, 20,000. 20,000 here and 20,000 here. 4th year, working capital upgrading in 2 years. That means 2 years, has already said here. Working capital at the end of the contract, that means at the end of 4th year. This is why we used 4th year's factors. We used here 4th year factors. We used here 2 years factors. We use in this case 4th year factors and annual cash inflows in 4th year factors. Okay, I hope so you are very clear to know the particular information. This is why we have to do it according to the sequence.